Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next, let's say 30 minutes here on Options Guide TV. Had a very exciting week so far in the markets. The last couple of weeks have been, well, you can't say that they've been boring. Let's put it that way. As far as the downturn that we had on Monday, we had a snapback. And interesting enough, okay, so we went out on Friday, and with the downturn in the market on Friday, decided to do a VIX trade in the VIX, the volatility index. And doing it on a Friday with a Wednesday expiration, I even acknowledged the fact that maybe we went a little bit too short in our time frame. And because Mondays just makes Monday such an emphasized day, and that usually after a long weekend, if you're going to have a downturn, Mondays are the day, and that happened. I don't want to get into why the pundits think it happened or how it happened, or the Japanese yen and that trade and everything that was going on. Bottom line is it happened, and I thought that our VIX trade was not going to pan out, and I looked at a possible adjustment, and lo and behold, I did say on Monday's show that it is very feasible that the market could come all the way back down and land somewhere within our strikes of our butterfly that we put on, our modified butterfly. And it did happen. It came all the way back. As a matter of fact, when we put it together, we actually, you could say we hit a home run on the trade. It's all about where the VRO settled today. And this is very important about the VIX index. Okay, first of all, the option contract stopped trading on Tuesday. So through most of the day, I should say at the end of the day, the VIX traded right around 24 to 24 and a half, right in that range. Had a weird spike up at the very end of the day. Not really sure exactly what happened, but it showed that it closed somewhere around 27. So you might have got out. I probably would have, considering I didn't want to take the overnight risk. But with the VIX, they look at the open and decide on the settlement value. And it usually comes out right around 10 o'clock, which in Eastern time, the market's open at 9:30. So about a half hour, sometimes an hour, you'll get the VRO, which is the settlement price of the VIX index. And that actually went out today at 22 and a half. So if we're looking at our trade, which I think, let's start there actually. So let's stay where we're at, and we're going to actually pull up the graphic instead of going to instead of going straight into the platform. And I'm going to pull up VRL. So give me another second here. Which, if you're on Yahoo, you want to put the little caret in to get the VRO symbol. So I'm going to pull that up too, right alongside of this. Okay. So here's our trade. Let's go look at it. So here's the screen grab that we got. And you know, I don't always want to just highlight winners. We had a rough week with the mega cap tech stocks as far as Options Guide TV was concerned. And with that said, we've done very well overall on a lot of our paper trades, especially considering that we're usually just looking at the trades during Options Guide TV. But last week we had a rough one. So I always want to highlight that. I don't want to just say that we're just touting trades where we made money. But on this trade, we actually came as close to a home run as you possibly could. We did the 25 strike, and I'm going to just pull this down just a little bit here, and I'm going to pull this over. We're going to be good. And here's where the settlement value as of 9:34 Eastern time, so they got it out pretty quick today. 2288 is where the VRO, the SIBO Volatility Index settlement, and this is a little character that you got to put in order to get that symbol. And it's delayed, but that's all it really means, is that they can't quote it real time, but when it's a settlement value, delayed is real time. And so with that said, that's where the market closed at. And here is our butterfly trade. Let me pull it back up again. And our mid price was 22. So we closed at 22.88, which is right about here. So if you rode this all the way to the end, you almost hit the maximum on a butterfly, which is crazy, but you might have closed it out yesterday. Very bluntly, you're hanging right around the 25 level. You know that if we get a little bit of a downturn on the market, that you're going to be 100% loser, or you're going to have a potential to have a big win. Okay, so maybe you looked at the markets after the close and try to decide if you think the market's going to go down or the market's going to go up. And in this instance, the market it just kind of settled down. That simple. Because if we look, this is the down day. This is actually the screenshot of the day that we put it on. It was 55 cents. Now it is trading. It settled at 22.88, so right around here. Max upside would have been, you put it on for 50 cents, you would have sold it for somewhere around 20. You have the maximum that you could have made on the trade is $3. The difference between the strikes, 25 to 22. So we made somewhere around 220 on this trade. If the market continued on down, we could have still made around $55 on the downside, and our risk was this direction. So in general, I really like the trade. I did feel like on Friday that we might have did too short term, but here's one of the biggest things about the butterfly, and this is why picking a time frame is so tough, is that especially when you're looking in the VIX, especially when you're trying to play the downside, you're trading volatility, and the actual volatility of the option contracts, which is actually highlighted by the VVIX, is a big issue here. And you need time decay to happen if you're correct on your forecast. You need implied volatility to come in. And in the VIX, that only really happens very close to the expiration. And so in this instance, yeah, would have hit a home run on the trade if you would have stuck it all the way out. If not, if you got out yesterday, you probably made 30 cents on the trade maximum. But now making $2.20 if you wrote it to the open. And that's always tough. I really don't like the settlements where you got that overnight risk and there's nothing that you can do to trade out of it. But with the VIX, with this low price, actually be obviously using speculative monies to be able to enter this trade, that's where you're at. And we did a rinse and repeat. And we came back, and because I felt like this was maybe a little bit too short term, we went a little bit longer term. But we looked at a trade with the actual monthly expiration in the VIX. And let's back out a little bit. And let's do the back out. And then we'll come back in and let's pull up our second trade that we're looking at in the VIX index. And I guess I'll start with the screenshot. So if you give me a second here, I wasn't thinking I was going to go there, but I'm kind of feeling screenshots right now. So here is our second trade. Boom. Okay, so once again, this is Tradier Pro software, but this is a different screen. This is just a screenshot of the trade. Now, when we were doing the trade during the day, the market was probably more towards this mid price of 132, but for a second it ticked down to 110. Markets were fairly wide. I was a little disappointed in the width of the bid-ask spread. And I think, once again, it's one of those things. The VIX is a very... it's a very popular index, and because of that, the Chicago Board Option Exchange, which this is their baby, decided to just open up the floodgates and set up a host of different VIX options, weeklies, the standard monthlies, everything about it, and it's kind of hurt the bid-ask spreads. If you got more products to choose from, the volume gets spread out more, and bid-ask spreads become a little bit wider. And I do really believe that. With that said, If you got it for $1.10, that's great. $1.32 was probably more feasible, but we did have the market come back down. The VIX was at 34. We looked at the futures. The futures are right around 30, so they were trading right about here. Same scenario. We're right in here. Right, the money shot is right about 23. So we have 4 points of upside as opposed to 3 points of upside on the very short-term VIX trade. If it continues all the way down, once again, we can make about 40. Well, it looks like about 40 bucks. So if it continues on down below the 21 level, that's where our protection is here, below the 21 level, we can make just about 40 bucks on that trade. Hopefully we land somewhere. We got a wider landing area somewhere between 21 and this is 25 and a half, right in that range. But we have more time for this to happen. Now, the markets came down. It's probably trading within that range, and I'll go look at the marketplace to try to determine that just by looking at the option chain to get that number. You can find delayed VIX futures quotes on the CBOE. If you go and you Google it, you can actually find delayed VIX futures quotes. So if you want to look at where that quote is at, I just always look at the put call ratio, and you just want to kind of line it up somewhere where the put and the call are fairly close in price. Okay. So let's see where this one's trading out. But obviously this should be up. And a little bit of it would be if the VVIX came down, if the actual volatility of the option contracts came down. So those are two things we're going to look at. And let's go do that. So let's back out again. And let's go to the Tradier Pro software. Okay, we are there. So right now we have SPX is up. It's up up 1.3%. Not anything to sneeze at. We got the Nasdaq up 1.6%. We got the Russell up about 0.8%. VIX down to 2284. VRO, this is where that ended up at. And here's the VVIX. Okay, so this came down 18 points today, but it's still extremely high. The VVIX was up around 180 at that point in time. And now it's just a little bit 130. So 100 is a solid number in the VVIX. So 100 is a solid number in the VVIX. And I can probably show you that. Let's see if I can do VVIX. And let's move this over. And we'll do days, and we'll go 800. Okay. Here's the volatility. Look at the few times in the few number of days that it was up above. I'm putting my cursor right at 100. And here's where we're hanging out at 131. So we need this to come off a little bit, and then this trade will become more profitable. And so we're definitely going to stay the course on the August and in the VIX. Oops, I'll pull that up. Foreshadowing the trade for today. So if we look at the VIX, and we're talking about the monthly expiration, notice there's no W on this. Here is the monthly expiration. And we have the market right at, let's see, 22 and 4. Gosh, we're right around 22 right now. So how am I figuring that out? Okay, so the 21 call, if I look at the ask, is 320. Over here is 250. Okay, so the call is higher than the put. Then you go to 22 and you see that the ask is 290 and the put is 325. So the market on this August 21st expiration has came all the way down to somewhere between 22 and 23 on this trade. And our midpoint, so we're well within the range. We could look at closing it out, but there's still too much implied volatility to make it real profitable. I would let the marketplace kind of ride in this range. We know that if anything, I think the path of least resistance is to the downside. And we know that if it does go down, we still are profitable on the trade from beginning to end. Okay. Any questions that you do have? Because first of all, my handle in Twitter is at Brian Overby, at my name. Very simple. I'm going to be posting an article about trading VIX options because I think it's very timely. And it's about the little hiccups and differences between VIX options and other type index options. So I'll be posting that in a few places, but the easiest place to find it is going to be on x.com. You could be watching this right now on x.com because we do stream the Options Guide TV via my Twitter and also the Tradier Twitter. And if you are in the Tradier Hub and you've built the sign on and you're watching Options Guide TV via the Hub, which is probably the best place to watch it, get access to all the speakers, you can put a question in. Also, if you're on the YouTube channel, logged in, once again, on the Tradier YouTube page, you can ask a question. So if you have questions about VIX options, I encourage you to ask them now. And with that said, we're going to head into Eli Lilly, and we're going to talk about that underlying stock and look at that and make that our paper trade going into Friday. We are on the tail end of earnings, and Lilly got beat up because of Novo Nordisk had a bad earnings report in theory, and it kind of hurt Eli Lilly a little bit. And they're going into their earnings, but they've had a very strong month. We actually, a part of our deep in the money call portfolio, we owned Eli Lilly option contracts. That portfolio is a little bit screwed up because of the split in that we had in NVIDIA. With that said, I digress. Let's look at a Lilly trade today. So let me pull up the option chain. And let's back out for 1 second, and let's go back to where we were. There we go. And let's check out options playbook. Okay. So my outlook and my strategy changed because of a little bit of the weakness from a competitor that kind of brought the underlying stock down. But the trade that I'm going to look at today is, 1 second, let me move Tradier Pro, and there it is. Okay. And here's the trade. Okay. So skip strike butterfly with calls. Kind of looked at this trade a little bit last week. I was trying to make it work in Amazon and it didn't. So we changed things up a little bit on that trade. Unfortunately, it didn't work out, but we did. But here's the setup. We're going to buy a call on the low end down here at strike A. We're going to sell 2 calls at strike B. We're going to skip strike C, and we're going to buy strike D. So in this whole scenario, we're going to try to get this done for a net credit to the account. We're going to be bullish in general on Eli Lilly, but if the market goes down or just stays flat, we're still going to be profitable on the trade. We're going to bring in a small net credit to the account. I like to do this on higher price stocks. I like to do it on stocks that are reporting closer to an expiration date. So they're going to report on Thursday before the open. Ideally, we would like them to do it at the close, like Amazon usually does. They announce on Thursdays before the close. And let me click this up. So ideally, we would like that, mainly because of the same things that we talked about with the butterfly that we looked at in the VIX options. You need implied volatility to come in. You need time decay to happen. And if you're landing somewhere, if you get it right and you land somewhere right around that middle strike, you got the potential for a home run. It's got to blow away earnings and end up all the way up here to get the max loss. We're going to go out probably a standard deviation move and anywhere in between. The stock's going to start way down here when we first put this trade on. So Eli Lilly works out because it's a higher price stock. They are announcing on a Thursday. Unfortunately, it's before the open, as I mentioned. But yeah, it's not a bad setup to look at a skip strike butterfly. So let's pop out and let's put that in, and that will be our paper trade for the day. Jumping back up. I hope you're not getting dizzy from all the times I'm going in and out, but here we go. We got the Tradier Pro software up. Lilly down 2.5% today, so nothing to sneeze at. If we look at the August 2nd expiration, that means we're going to have 2 full days of trade. I'm probably going to put this trade on closer to the close tonight, but the setup is still going to be the same. So the market at $772.91. Let's call it 773 if we round up. We want to start by knowing what the expected move is. And so if we buy the at the money call and the at the money put, when I did the math before the show started, we were right around $56, which is about a 7% move. It's already down 2% based off of competitors' earnings. So the market is down a little bit on it. But with that said, there's about a 7% move. A 1 standard deviation move, which inside the Tradier Pro software, we highlight that, and that it's right around this shaded area. So the market has came down since I initially set this up. So I might move this a little bit. But right now, this is a net credit of 39 cents to the account. It was at 51. So once again, like I said, I would adjust this. I'm going to start right about a 1 standard deviation move, a $50 move, which is the expected move by the close on Friday. And it's always this, a lot of times the pundits won't mention that when they say that Lilly's looking to move about 7% after earnings, they don't mention the fact that that is the nearest expiration. So that's 7% by the close on Friday, not after the open on Thursday. But it's not an exact science to start with. So it just gives you a little bit of a base. I don't mind that. And if they had to explain that every single time, they'd be wasting a lot of valuable time on their shows. So we're still looking at that type of move, a 50-point move on this underlying. We're talking about delta right around here. So we're looking at 75, that's 25, somewhere right around the 815, 820, 20, yeah, right around 820, just rounding off. So that's about what, if the move was positive, the over-under is right around 820 on Eli Lilly, on LLY. And the 1 standard deviation move, which happens less, it's right around usually a 16 delta, is going to be all the way up around 842. Okay. Our maximum risk on this trade, because we're skipping that strike, is if it goes more than a 1 standard deviation move. And we're going to set that up. So we're going to set this up almost like a credit spread, saying that, oh, well, if the market goes down, we're going to make a small credit on this trade. But we have a chance that we could land somewhere within our strikes, within a 1 standard deviation. There's a probability of that happening, at least a 16% chance that it might make that move. And then we're got a lower probability that we hit the maximum rate. You'd look at about a double the standard deviation move, definitely double the expected move, which would be at least 100 points. So we're at 772. I'm going to adjust my strikes. Let's clear them out because the market has gone down since I first looked at this trade. And like I said, I'm going to emphasize it again. I would use this format where I'm going out about a standard deviation and look to do this a little closer to the close, mainly because of the volatility of Eli Lilly today. Okay, so 840, let's make the math simple. We're going to buy this one. 847.50. You want this to be as long as possible, but if you go 10 points, you might not get it done for a net credit. So I'm going to go 7.5 points because that is available to me. And then from there, you're looking at the 855 strike, 62.50 right here. And we need to add one to this trade right there. 44 cents. Okay, so my initial trade was 55. We're going to ride with this one. You know, at this point in time, 42-cent credit. I really wanted to get a 50-cent credit, but we're dealing with live markets. This is the way it works. So this is our skip strike butterfly. We're literally skipping the 855 strike. We're embedding a credit spread to pay for the butterfly. by skipping that strike. That's why I like to call it. That's why in my book, I called it a skip strike butterfly, as opposed to a modified butterfly or a broken wing butterfly. Those are some of the other names for it, but this actually describes what you're doing. You're skipping that strike, and that embeds a credit spread from 855 to 862.50, and that credit spread actually pays for the butterfly. And that's what the theme is. Now let's send it to the what if calculator so that it looks a lot like the graph that we saw inside the options playbook. Okay, market's down here. Here's our one standard deviation move is right about here. Our expected move is right or down around here based off of where that underlying is at. So if we go anywhere within the expected move or that, and that's ideal. Our ideal situation would be that the market opened tomorrow and it was up, that the news was good, because expected move doesn't have any regard to direction. Neither does standard deviation. That is no hint. All it's saying is just pure math, that this is the move that the marketplace is saying is feasible after an earnings report. And if it's bad, it could be to the downside. Okay, so we're here. Now, we'd ideally open the expected move and then start drifting north, start drifting towards our price. And by the Friday and the close, we're somewhere in this area. And I'll pull this up. Okay, so the stock is here. Let me zoom in right like this, because we do not want it to open here, because then we got a real tough call. If we open here, you see by the profit and loss calculator that we're actually down on that position, and we're sitting right where we want to be. Ultimately, each day that goes by, and I can change this in the calculator, we're going to see this thing start climbing towards that peak. And now we actually got to get into closer to the close. So let's do that. And then you start seeing the marketplace start moving and acting like this. So if it opened tomorrow right at our short strike of our butterfly, I think I'm going to close out, because I don't want the risk. I'm going to be down on the position. I'm just going to take the trade off. Ideally, we'd open somewhere around here. If we open here, that's great. We're still doing wonderful. Market decides to go down. Oh, well, we made our 42 cents. Market continues on up. Well, then up in this range, we got a chance. We need 1 full days of time decay in order for this to actually kind of pan out for us. And then ultimately at expiration, we land right here. And that would be our home run, like we had happen in the VIX today. So I have a couple interesting trades on. The VIX trade was very interesting, a great learning experience. And then I'm going to post a blog, and it's going to come out today. We're going to post it in Twitter and a few other places. And then this will be our paper trade. So I'll take a screenshot of this right now, and we'll look at this trade on Friday's Options Guy TV. I'm looking right now at the comments. I do not see any questions or comments. So that being said, thanks for stopping by Options Guide TV. We will see you this Friday for the next edition, and we'll see what happens with our Eli Lilly trade. And we're getting to the end of earnings season here. We're getting into September and October, which are going to be kind of scary months. Well, they usually are. The calendar says so, but doesn't necessarily have to happen each year in, year out. So definitely want to tune in to see how we're going to deal with the rate cuts that are coming in September, according to the Fed. Is it going to be a 50 basis point move or a 25 basis point move? A lot of interesting stuff happening in the markets. Thanks for stopping in, and we'll see you this Friday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.